We are talking today about crowdsourcing for equity in different in different aspects of carbon removal. Happy to see so many people here. Currently, we are recording this to let you know, and it will be put on our YouTube channel afterwards. We have Paul Gambill, CEO of Nori here, as well as Yishan Wong of Terraformation, moderated by Mr. Cheater Jankowski. So, and we'll be going back to him. Per usual, we're going to go through maybe 40 minutes of discussion, followed by Q&A from all of you. So if you have something, please feel free to that you'd like to ask our panelists, please put it into the chat. At the top of the hour, we'll stop and then go into Zoom breakout rooms for networking post discussion. And I'll also come on with a couple of announcements about our next upcoming events, which we look to forward to see you at as well. Just for the record, a couple of other housekeeping items. First of all, happy St. Patrick's Day, everyone. Also, as Tito and Paul and Yishan noted at the top, I am wearing blue and yellow for a very specific reason today, thinking of all the people of Ukraine during these very trying times. So with that, want to say welcome again, and Tito, please take it away.
All right, good stuff. Thank you, Jason. Hey, Paul. Hey, Yishan. Welcome to the stage at AirMiners. Aloha. Welcome to everybody else. This topic came up because in our quest to get to gigaton scale carbon dioxide removal, creating new ideas, creating new companies, getting stuff out of the lab, finding customers, all that takes capital. And through the conversations with founders in the field, through conversations with teams as part of the AirMiners Launchpad Accelerator, getting your company funded is a key part of getting things off the ground. And so there's some traditional options that we've talked before about at AirMiners in terms of kind of more venture capital options that are kind of go through the more traditional process, but hearing from founders kind of curiosity around some of these other options that have come up. And so today we're talking with two founders who have themselves worked on crowd equity, crowd token campaigns, and they're going to share a bit about kind of how that came up for them and some lessons learned for other founders in the space. And as Jason said, about 40 minutes in, we're also going to be switching over to questions from the audience. And yeah, we just encourage people that are in their fundraising process to jump in with questions about how are you thinking about this? What do you need to hear more about this process? And if you're not fundraising for a company, or if you're advising or mentoring companies, come in with what would it take for you to be able to recommend this to other teams, or be able to give them guidance on that. So without further ado, wanted to welcome Yishan, who is the CEO of Terraformation. Welcome, Yishan, and welcome to Paul, the CEO of Nori. So we're glad to have you both here. Just to kick it off, for a bit of background, could you tell us kind of where you started in carbon removal, what got you interested in carbon removal, and then a little bit about the crowdfunding equity project that you had as part of your company. Let's and start with Yishan.
Cool. Our carbon removal method is simple. It is restoring forests, because trees and plants take CO2 out of the air when they grow. So our idea was help the world do much more of that, like many orders of magnitude more. And as it is with simple solutions, taking them up like a billion scale, it becomes a non-trivial problem. So I figured that was like a meaty enough problem to solve. For crowdfunding, we went through like traditional fundraising, but one of the key elements of reforestation is that it's like very parallelizable, right? So, and it turns out like key to its success is not like one company doing it, but rather getting the entire world to do it. And so it's actually a major communications problem. And similar to the way like an IPO isn't just about raising money, it's a huge publicity event. Crowdfunding makes it so that you can, enormously increase the number of people who have a vested economic interest in your success. And that's something we wanted to do. So that was one of the drivers for why we did that. I can get into more details after the intro.
Nice, thanks, Yishan. Paul.
I got into carbon removal in 2015. I was working in software, trying to figure out what I wanted to work on next. And I read a magazine article about how climate scientists were becoming very depressed because no one was listening to them. And then I started wondering, well, why don't we just pull the carbon back out? Because it seems pretty straightforward. And it didn't seem like anyone anywhere in the world at the time was talking about it. I started a meetup group in Seattle where I've been since 2011, and we pretty quickly networked with every other group in the world that was working on carbon removal because there were 3 or 4 of them. And then after a while, we figured out that there were plenty of different ways of pulling carbon out of the air, but nothing that was happening at any significantly large scale. And it seemed like what was actually missing was a financial incentive for more and more people to enter the space and leverage innovation and market forces to pull more carbon out. So that was the genesis for what Nori is. We're a marketplace for carbon removal. And like there are a lot of companies that do carbon crediting and carbon removal crediting. And I suppose that's what we do too. But really what our mission is about establishing a financial price discovery mechanism. What is the value of actually pulling carbon out of the air? This was always going to be a crypto first thing, knowing that we wanted that price discovery to happen on a cryptocurrency that we created. And I got into Bitcoin in 2011. So this is something that was like very native to me. And in 2018, we got approached with the opportunity to go on a Shark Tank style TV show hosted by Tim Draper, who's a relatively famous VC. And in order to do that, we had to offer a crowdfund campaign on Republic. And at the time, we had been thinking originally that we wanted to do like a token offering, like an ICO, the way that things went down in crypto in 2017. The SEC does not allow that at all in the US. And so by going through Republic and doing a crowd campaign was really the only way that we could make token purchases available to retail investors who are not accredited investors. So for us, it was more of a necessity in order to help distribute more of the tokens to more of the community and not have it just be controlled by founders and well-connected VCs. All that said, I don't know if I would do it again. I'm glad that we did it, but knowing what I know now, it wasn't worth the money. So I can dig into that as we go.
Yeah, good premise. Yeah, it's definitely dig into both of those projects. I think Yishan, it'd be good to hear a bit more about the setup for yours. Like when you think about the goals for this crowd equity fundraising. You talked about kind of this communications problem. How did you're starting this company? How did starting something on Republic come up? For Paul, it sounds like Tim Draper and Republic, kind of a nudge from them.
So there's a whole bunch of like little mechanical details around this that it's like pretty important for anyone who's considering it to really be aware of. And so I'll try to cover as many of those details as possible, and I hope Paul will, any that he knows that I don't know, because I think actually many of these decisions will turn on 1 or 2 of those little details. Just to sort of set that context, it's very important because this type of crowdfunding has a lot of similarities to doing an IPO, and when companies do IPOs. The reason they pay bankers, now I know, the reason they pay bankers huge fees is because IPOs are in fact super, super complex. right? From both a financial and legal and regulatory and even like a public relations standpoint, right? The fact that the bankers know all this stuff about how to do it, like they're adding value because like it's very hard to do and very, very complex. And there's all these like little like pitfalls. And it's also why like you'll often see like a company, they'll like hire a CFO, and it's like basically, to anyone who understands, it's like a signal that they're going to IPO because they look for a CFO with like specific public company experience, or ideally one who's taken a company public, because it's a thing that you have to know. And you know, they basically can't fail but signal to the world that they're doing that when they hire that kind of CFO. And that is because there's so much specialized knowledge. What I found from this crowdfunding is that it's not quite the same scale of complexity. So I've been through some companies that have gone through the IPO process, and though I wasn't like, you know, in the exec suite at the time, it was like clear that it was extremely complex. But here, there's also just a whole bunch of complexities. But there isn't as much of a, I guess what you'd call like service industry of experts. You don't have a bunch of bankers who can help you do your crowdfunding. And as a result, you're gonna run into all sorts of just like little issues that you didn't know. For example, one thing that many people may not know is that there are like 2 different types or amounts of fundraising that are dictated by the regulations. And the line is 1.07 million. And so you can raise between, based on the regulation, you can raise between 0 and 1.07 million, or up to 5 million. And so there's this like weird little arbitrary line. And the reason it exists is for like historical reasons. I think Paul might actually be a little bit more familiar with it because he did it in the era where the limit was in fact 1.07. So that like the regulations allowed it up to 1.07 million, and then later increased the cap to 5. And there are different rules depending on whether or not you're going to raise up to 1.07 or 5 million, which we were not totally aware of, right? And so you don't want to go into this process like discovering things in the process. You actually want to know about it all beforehand. For example, one of those differences is if you are gonna do, if you're gonna go all the way up to like the 5 million one, you essentially have to do an audit and have it certified by a CPA, and that's made public. So that is sort of S1 like, in that you have to answer a ton of questions that are very, very much like an S1. It's like S1 light, and it's simpler than if you're a public company, because if you're a small startup, your P&L might be like, we lost $2 million last year, right? and that's it, right? And you don't have a bunch of really complex operations, but it's still like an audit and a full readout of your financial situation, and you have all these risk factors and all this stuff, and you're filling out this thing that's very much like an S1. And the difference in the degree to which the SEC relates to it is, with an S1, you submit it to the SEC, they come back with comments and they say like, no, you've got to have more detail here, you got to do whatever, and you'll go like back and forth. It's very complex and involves lots of layers. With this, you have to submit, I think it was a Schedule C or something. And that one, okay, yeah, Paul's nodding, so it's corroborating my rough memory of the exact form. You just submit it, right? It's a one-way thing. They have a website that acknowledges submission, and once you've done that, then you can go. So there isn't like a back and forth. So it's a lighter weight process, but there's still many elements of it that are similar to the S1 and the IPO process. So in our case, one of the reasons that we wanted to do this was more of a marketing benefit, right? Because we realized as we were sort of like mapping out the strategy for like, how can we as one company champion and accelerate worldwide forest restoration as a primary carbon drawdown method, we realized that it's more about showing that it can be done, telling everyone that it needs to be done, and then saying to everyone, hey, you can do this too, right? And you got to say that to as many people as possible. And that's very, very much a communications problem, which, we found like, okay, there have been incidences that have shown that you can convince a sufficiently large number of people of a thing within a certain time frame, right? So it's like, okay, so this should be like theoretically possible. And it helps if you are able to get a bunch of people like economically vested in those outcomes, right? And some of that is by, they have businesses or, start businesses that benefit from it. And the other is they're able to invest in it. So we went through the traditional fundraising route. We raised a total of like 2 rounds, a $5 million seed round, and then later a $30 million Series A. But one of the things was like, if we're like successful, basically if any climate company is successful to the ultimate degree that they want to be, which is to say they solve climate change, like that's a value creation act worth like trillions of dollars, frankly. Like people do not really fully recognize this. And so if that happens, the shareholders of the company, right, like become enormously wealthy. And what we didn't want was a bunch of wealthy investors becoming very wealthy, and then all the people who backed us in the beginning, essentially getting nothing but their climate fixed, right? Which is a pretty big thing, right? But it would feel kind of shitty. So around that time, the particular regulation that raised the limit from 1.07 to 5 million changed. It went into effect, and immediately there was like, I think this was actually kind of a flagship raise, and they knew it was happening, so they kicked it off the day that it became legal. Sahil Lavingia from Gumroad launched a campaign that was like pretty high profile, where he like immediately like filled the quota of like 5 million. And it was like a pretty big deal, because it showed that, a company could raise money from its users and from regular retail investors up to 5 million. And it was just like, it was really showing that it would like change the game, right? Because being able to raise 5 million is a non-trivial amount. And it seemed like it went pretty smoothly for them, right? And so like that happened around the time that we were closing the Series A, and we thought, oh wait, this is really good. We could raise another 5 million, which is like small compared to the Series A. But if we could get thousands of retail investors, because we already knew that we had like thousands of people who were supporting us, and we would get inquiries all the time from just random people saying, hey, how can I invest in this company, right? And we're like, well, we're a private company, you can't, right? And like an IPO would be like years later if we ever did that. But here's this thing where you can allow regular retail investors, like you're on the ground supporters, people who want to put in like $100, right, to back you. And Sahil made it look really easy and simple, right? Which I think was kind of part of the point. And it wasn't that easy and simple, but he did a great job of just publicizing it. And yeah, so that's what made us decide, hey, let's do this. We could allow 1,000 people or thousands of people to get involved.
Were there any other ways that you looked at solving that, like that communications problem, in the sense of, so for example, think about Kickstarter, right? Like not equity, just like you get t-shirts and prizes and stuff like that. That's some way of getting people invested in a way. How did you think about kind of those other options like that as a way to get people involved?
Technically speaking, we have considered those. But they just didn't seem very appropriate, because they also seemed like somewhat short-term delivery. I mean, people think of like a Kickstarter, it's like you put your money in and like 3 years later you get something. But that's still short-term compared to what we're doing. And in order to run a really good Kickstarter campaign with large dollar amounts, you have to do a lot of preparation. And it didn't actually seem worth the ROI, and it didn't really fit with how Kickstarters or Indiegogos work. So we had looked into it, but it just didn't seem appropriate for us.
Yeah, it sounds like it's a bit orthogonal to what you were doing. You were pitching, you were raising a fund. Let's just take those assets and say like, hey, you can join this you can join this too.
Yeah, one of the things that Sahil did that was very skilled was when they advertised it, they said, you can invest, anyone can now invest at the same terms as, these institutional investors who just did their Series A or whichever round it was. And that's like a really good way of advertising it, because basically like the regular Joe can get the same terms as the institutionals. So that makes it make a lot more sense as an investment.
Sure, got it. That's good. Paul, I'm curious to hear from you, like kind of when you were at, like, what did the forks in the road look like? And one of them you're looking down is like this kind of Republic token sale. Were there any other options that you were thinking about in terms of, solving actually, I mean, just to kind of go back to it, like, what was the core issue that you saw that it would solve for, you thought it would solve for your team?
I mean, ours was a series of like basically accidental decisions where we wanted to do we wanted a token distribution that would result in tokens being owned by many, in the same way that Yishan was talking about it, like having many people with like a stake in your success. We wanted to do the same thing with the tokens, but the SEC has made it so difficult to do that in the US that this was the only viable path to do so. And our timing ended up being absolutely terrible. It was in the winter of 2018, which is the absolute bottom of the crypto bear market of 2018 to 2020. And it has really just kind of more been a pain in the ass than anything else, to be totally honest. We raised $145,000 off of 365 individuals, and because it was tokens and not equity, it was actually structured like a debt instrument. It was a convertible note, essentially, where they lend us money and then we can pay back that debt in the form of tokens at a price that was agreed upon at the time. And I think if you are interested in starting a company and you need funding for it, I would not do a crowdfund campaign if what you need is money, or what you need is like useful advice. Because that's the other thing is, this is my first venture-backed startup, and what I have learned is, like, we have some awesome VC investors backing us, and I look forward to our board meetings. They're genuinely useful, and I get a lot of value out of having people who are experienced also helping hold me accountable as a CEO. And you don't get that from crowdfund campaigns. So the value that I see in a crowd campaign is, for the money, yes, but it's not that much. And two is the wide distribution and having lots of people with skin in the game, like Yishan was describing. So I would not ever myself, if I were to do things over again, I would not use that as a starting point. It's like an extra thing on top. But also, like Yishan said, the documentation is a lot. We spent between $60,000 to $80,000 on the legal work, paperwork preparation, and getting our disclosures together and all of that. And like I said, we raised 145. We spent 80 on legal fees. Yeah, just wasn't really the success we had hoped for. And then also going back to any sort of the idea of any crowd campaign, whether it's like a Kickstarter Indiegogo thing or an equity-based thing, like on any of these platforms like Republic or WeFund or whatever. The successful ones already know they're going to be successful before they turn it on, because they've already got pre-commitments from people. They've already got like a giant newsletter with X number of subscribers who have clicked a button that says that they will do it when they sign up. This absolutely never works if you just turn it on and hope that people will show up. So that's another thing, is you have to do an enormous amount of marketing preparation for it. Just in the same way, if you were doing like a consumer product marketing launch, you kind of need to do the same level of work for this.
Yeah, helpful context in terms of, like, would you do this again is always a good question. I'm curious, Yishan, kind of where you come at from that. Would you do this again? Like, what have you seen as the outcomes? I think you closed a month ago or so it's still pretty fresh, but yeah.
Yeah, so we are still close. So the closing process is much longer than you think. So remind me to talk a bit more about that. It's more complex than you think, and I'll bet Paul probably has a similar experience. For example, the closing process is much longer than when you're working with traditional VCs. In terms of whether or not we would do it again, I think our economics netted out a bit better than Paul's. Although I note that, like, if he did that in the bottom of 2018, I think, wow, that's a pretty good time to buy his tokens. I should have gotten involved in that. I would have gotten a pretty good deal. I mean, in our case, I think we spent roughly a similar amount in legal fees, or legal and accounting fees. Like, you have to pay an auditor, and you sort of go back and forth a little bit because the laws are pretty clear, but not every question is totally answered. So there's a bit of like, you got to ask the lawyer for their opinion on this, or, you know, little thing. We went into it with a bit more eyes open, knowing that we were going to have to do a lot of marketing. So we had a whole marketing campaign oriented around it. And we knew that that was going to cost money. I don't quote me on this, but I think our total expenses, we may have committed to actually spending something like 1 or maybe even 2 million on the marketing aspect of this. So that would actually say that our like ratio of return might not be that far from Paul's. But in our case, we really did view this as primarily a marketing activity, right? Like, if you can get 1,000 people who are willing to essentially sign up for an email spam list, right, so that we can talk to them whenever, and they have a vested interest. And then later you get a headline saying, you know, we raised another 5 million, right? Those are all like positive marketing things, and it's an explicit strategic aim of the company to market as much as possible, to get the word out as much as possible about reforestation as a solution, forest restoration as a solution, and terraformation as, like, you know, a champion of that. So in that sense, it is successful. It's not, I guess, what you'd call the highest leverage fundraising. If you're, you know, trying to maximize dollar per time, like dollar per founder bandwidth time, right, which is one of your scarcest resources. When we raised the 30 million round, it took maybe like a month of pitching, and, you know, it was like most of my time and, you know, a couple other very early employees time to do that, and then closing that took, it's funny, it took like a month of pitching and maybe like 2 or 3 months to actually close. And this just took like months and months of preparation. Like, we did not know when we started that, for example, it would take something like 3 months to complete the audit. Even though it was like the simplest audit in the world, because it was auditing our first year of operation, where it was like, okay, we lost, you know, $2 million. It's like, this is what the P&L says, right? And in fact, we wanted to time the crowd raise to go out right after we closed the Series A. But that didn't happen because we found out, oh, we have to do this audit. This audit is going to take 3 months. And we're like, oh, crap. That means it's not going to go out until August. August is also when every investor goes on vacation. So we had to push it out past that into September. And we had closed our Series A. I think we announced the close of it in May, which is when we would have liked. So that was one thing that was like a big surprise. Luckily, it's all turned out well. You know, we hit the cap. If I had to do it all over again, I would have, you know, I would have like managed the timeline much more differently. Although an interesting thing was, like, when we were preparing the marketing for this, we also wanted to talk about our institutional investors, right? It's like, these people have also invested, you've invested at the same terms. But of course, if you're trying to do that 3 months early, you may not have closed your institutional investors yet, right? So there's this whole like sequencing issue where it benefits you to raise an institutional round first, because that's a positive signaling thing to the crowdfund, right? Like many crowdfunding or crowd equity retail investors invested because of the institutional investors who were in our round, because that's a positive signal. It's like everyone wants to invest in the same thing that Sam Altman and Naval, right? And like, oh, it's good, right? And so there's a whole bunch of things around like timeline that we didn't know that I would do differently. And then marketing, you are really driving your own marketing. Like you should be prepared, like Paul said, to do this whole marketing campaign. We had one and it went all right. I mean, we got to success, but for a while, as we were approaching the finish line, we were a little bit like worried, right? Like, have we done enough marketing? So I think like being much more conscious of the marketing requirement of you need to be the one to promote your fundraise. So there's the same way as like, if you're trying to raise an institutional round, you can't just like say you're raising an institutional round and wait for VCs to come to you, right? Like that's not going to happen, right? You have to go and talk to people. This is, you have to go and talk to the thousands of people. Like Paul said, if you have a bunch of customers, Sahil's situation was great. He had a bunch of like content creators, right? Like users who were making money on his platform. So he had a huge distribution list that he was definitely able to go to and say, hey, we're going to offer shares in Gumroad. Do you want to invest, right? So there were a ton of people like right off the bat. I think he had 1,000 or 2,000 signed up when they were opening. So we didn't have that. We did have a newsletter. We have, collectively a pretty big network. And at the end, we actually did some just like pure advertising. And so you have to consciously be aware that you have to do that. If you're trying to get a lot of small investors at the $5 million level, we're talking about like 3,000 investors, right? So that's a lot of people that you have to talk to, and you have to, actually go out there and do the legwork. So
which
like
also means lots of answering of questions and stuff like that too, because we got tons of those that took a lot of time to answer.
Yes. So that's another big thing. There's sort of a Q&A thing, and prospective investors can ask questions, and you've got to answer them. And if you don't answer them, it's kind of bad for your fundraise. But the problem is, it's just like this ongoing stream of questions, and the old questions get pushed down, and so you actually end up answering the same questions over and over, because they all ask very similar questions. But like if you posted a really good answer to that, it's like pushed down. So it's like you sort of have to answer it again. I don't think there's a place for, I guess you can make like a FAQ, right? We probably should have actively made a FAQ based on those questions.
That assumes they read it though.
Yeah, and so exactly, like not everyone reads everything. It's just they'll ask like the same question, and it's like a question that's like, didn't you read this? But you still have to answer. You can't just like leave this open question hanging there. So that's also a big time investment thing. And we ended up like having to pass it back and forth between like different execs to answer the same question over and over. So there's a time cost. There's a time planning cost. There's a advertising cost. It's pretty expensive along many dimensions.
Definitely, pretty clear story. I think we're seeing some questions pop up in the chat, so encourage people to ask those questions again. Specifically, if you're a founder looking at fundraising as this. Hey Jason, I'm trying to think of any other questions. It sounds like this is it's a very involved process. It's more than you anticipated, more than you signed up for. Yishan, you said you're still closing it. So in terms of like kind of how, post close, what are the outcomes in terms of that? It sounds like maybe it's still kind of ahead of you, but like maybe you could speak to what do you hope some of the outcomes are, right? Like doing all this work in the first year of your company, how do you hope these few thousand people investing in the company pays off over the next decade?
There's a whole bunch of things there. So, and I'm also seeing some of the questions. I guess one thing is to point out is, although there are many things that we did not anticipate or didn't know going in, Republic actually, I don't know how the other platforms do it, but Republic actually does a good job of hand-holding you telling you a lot of things about what to expect. They give you a lot of information. It's actually just that, like, there's so much. Republic does a ton for you and tells you a whole bunch of stuff and helps you out a whole bunch. And there's even more that, like, they didn't tell us and we found out later, right? So it's not that they did a bad job. They did a very good job. And then there's even more. For example, the FAQ on their page is really complete. There's a lot of information on it. And after we read it, we felt pretty good. We just didn't know that there was even more stuff, right? And then, oh, I forgot.
Would it help to explain kind of the legislative regulatory history here? Because I think that might help give some context for why it is so complicated. Because, you know, going back to after the stock market crash of 1929, Congress passed the Securities Act in 1933, which basically put rules in place around how companies could raise money from the public. Before, it was just kind of willy-nilly. And after that, they instituted rules around, if you were going to make an offering of shares in your company to the public, then you have to do a public registration. And there are certain requirements about what you have to disclose about your company. This was to prevent fraud, to make sure that you're not like preventing false financials or other stuff like that. Over time, though, they have continued to add more and more and more regulations on it. And there have been some paths that have been forged to make it easier. And so there are different exemptions that the SEC has come up with, Regulation D being the most commonly used one, for which you can raise money from private investors. And so when you hear about startups that raise like a seed round, a Series A, these are Reg D exemption raises. And what they're doing is taking in money from accredited investors, which means if they are an entity or an individual, that they basically have at least $1 million. And then there are a couple other requirements that they have to pass. And then you can do that. And then you have to file information about that either at the national level or with every state from every investor you take in. It's pretty straightforward. It's not that much work. There's far more like legal paperwork done on the private contract side, like between the company and the investors. That's what takes up the vast majority of time. Very little to do with the government. But when you start doing crowdfunding, then that's taking advantage of a law that was passed, I think in 2011, called the Jobs Act, which was trying to rectify the problem that, you know, when you think about it, the rules around accredited investors are just protecting the rich, basically. Like the vast, like you're not going to make that much money by trading on the stock market compared to if you were as an individual able to invest in early stage startups. That's where like the high like gains can be made. And those are only accessible to people who already have a lot of wealth. So the Jobs Act was an attempt to try to open this up more with still a lot of rules around it so that these opportunities could be more available to retail investors, regular everyday people. In practice, though, they put so many rules in place to protect the investors that it just results in all of this headache that we've been describing. And so personally, I don't think it's effective in accomplishing that objective that was laid out. But that's why these rules are in place this way, and why they're like the limit of the 1.07 million, and the recent change up to 5 million. That was a rulemaking that was issued by the SEC, I think last year or the year before. So it's helpful to know that context and knowing what your options are. Like if you want to raise money in the fastest and easiest way possible, you go for a Reg D exemption. Like there's no question. That's the easiest one. If you have different objectives that are not just about money, then this could be a potential solution for you.
Thank you. I forgot to give all of that basic background about it.
I wish I didn't know all of that, you know?
Yeah. I sort of assumed that everyone knew that, but I realized that's not. Yeah. So the whole accredited investors thing and the history of how that came to be. Just a bit of like specific detail. I think the Reg CF crowdfunding makes it so that a startup can now raise up to 5 million from the public, from non-accredited investors, with no investor investing more than $5,000. And so the idea there is like you limit the degree to which an unsophisticated investor can lose money, right? If this like somewhat slightly looser regulation, regulated thing is like offering some sort of security. But it's like pretty tight given the level of audit that we had to do anyways. So
Sorry.
Yeah, good to have those details. Hey, Jason.
Hey, sorry to jump in here. I just wanted to say, looks like we're ready for some questions and answers. And first we want to go to Marieh Mehran.
Hi, thank you so much for explaining. It was very helpful, especially with the legal aspect of it, which I didn't think of as much. So I had a couple of questions. My first question is like, how did you first like decide to go with Republic? Like, why not other platforms? Second one, how early did you start planning for the campaign, like before launch, and how, like, what was kind of your marketing strategy in order to get the most amount of people to start investing, and how did you create that list of first investors? I have a couple more questions too, but we can start with this. Thank you.
Paul, do you want to go first or should I?
I'll go first because mine will be brief, a lot briefer than yours will be, I'm sure. We chose Republic because that was who was partnered with Meet the Drapers. Although I will say I have been an investor in different WeFunder campaigns, and then I talked a lot with the team at Start Engine, and I think Republic is the highest quality, like easiest to work with, most reliable of the ones that I know based on my own personal experience. For the marketing side, we had no clue what we were doing. We were all first-time founders, and we hired a small agency here in Seattle to help us with digital marketing. Like, we were just trying to do like Facebook ads and that kind of thing. We ended up getting stymied and never even got anything off the ground because Facebook was blocking anything to do with cryptocurrency, and at the time was blocking anything to do with climate change too. So it didn't work. And we should have started a lot earlier than we did.
Man, having worked at Facebook long ago, I apologize on behalf of Facebook. Man, we also went with Republic because they appeared to be like the highest quality one. There were like two main data points. One is that Sahil used it, and I like know Sahil personally. The other is that Republic's CEO was the former general counsel of AngelList. And so it turns out that Republic is like in the AngelList sort of family of companies. And then the whole Jobs Act thing is also related to AngelList. So there's like a whole, like all of the initiatives to improve the fundraising situation for startups and protect that ecosystem. A lot of that has been initiated through AngelList. And so Republic, I think, they were ready for that regulation change. They knew exactly what it was going to be, because they were very, very familiar with it, and like were related to the people who like lobbied for it and like, helped co-write that legislation. And so, if you have like the CEO was the former GC of AngelList, which knows how all the legislation works, it's like, okay, that's probably like the most knowledgeable platform. And in a situation like this, you're not going for like the cheapest thing, you're going for the highest quality thing, right? Which is why people go with like expensive bankers for IPOs instead of like cheapo banker. So, and like I said, they did a really good job of answering like tons and tons of questions, because like when we started this, we knew nothing, right? And so we learned all this stuff. There's a couple remaining things that we didn't know, which I'll just outline here so that everyone will know them. One is that if you're doing a large raise, unless you have a situation like Sahil's, not all of your investors will be small retail investors. Most of them will be, like maybe you'll get like 80 or 90%, but you'll also get like a couple like big investors. So if you have accredited investors can invest more than the $5,000 limit. They just have to like go to Republic and say like, I'm an accredited investor. They click the button that says they're accredited, and they can put in more, like a regular angel amount. Like we had a number of investors who invested like, much larger amounts, like ranging from 20,000 to like 500,000, right? Like angel investment amounts. Republic was actually not fully prepared to be able to process all that. When you have an investor come in, they actually do a KYC process to verify them. And so like the KYC process, they've got it sort of streamlined for the regular retail investor. You verify your identity. But ironically, for the larger, more accredited investors who you think would be like easier to verify and have made other big investments, like many of them invest through like trusts or whatever, right? And so like that requires like just an extra bit of work because you have to verify that they own the trust is in good legal standing, and a whole bunch of other stuff. And they didn't really have that process in place. What's remarkable is that like because our fundraise took several months, they actually like wrote that code in the meantime. And so like later investors were verified a bit more well, although even at the end, it was still very hard. The process is kind of an exceptional one that they weren't originally designed to support. So ironically, you'll have like large investors who are, really important, right? Because like you really don't want to piss off the guys that come in with like 500K. And the flow, like for some of them, like the flow was just broken. Right. And I'm lucky that like many of them knew us personally, and we were, like, we're really sorry, right? Because like, it feels really bad when someone comes in and says, yeah, I want to give you $500,000, and the website says like, 404. Right. So we ran into that like a few times, but Republic's success depends on successful, high profile, large fundraising, right? Like if you're a flagship, like a big raise, and you have big, like investors, they really do care about you. So your incentives are aligned. They're going to work and try to make it happen. But there's still that area where there's kind of growing pains. The other thing that we didn't know is that the way you close is you are in fact doing a close of every single investor. So if you've ever done an institutional round or an angel round, especially like, let's say you do an angel round with like 30 angels, you have to close with every single angel. And it's like a minor, straightforward legal process where you sign some stuff and then you take money. But every minor, straightforward legal process still takes many days. And if you have 30 of them to do, it can actually take like on the order of like 1 or 2 months for whatever reason, even if you have angels who are like, yes, I'll sign, they're just like, non-problematic, very founder-friendly angels. If you have thousands of investors, you have to go through this process where on their behalf, Republic will register a custodial account to hold their securities. I'm not sure exactly what it is, but like there's a bank that they work with that establishes a custodial account for them. They do the KYC for all the investors. And that bank has to then like verify that they're a real person. And there's this whole process. That's what takes months to close. Now, the nice thing is if your campaign runs for months and you have investors who invest and confirm their investment early on, they can start that process on a rolling basis. So what happened with us is at the end of our campaign, at the end, within a week or so, they were able to immediately give us like a bit more, like maybe like 60% of the funds of the total amount, because those people invested earlier. And so they had been able to do all of that, establish the custodial accounts, do the KYC, and get the funds from the investors. So they were able to give us some of the funds. But for all the people who invested like near the end, they were all still going through that process. And depending on like just various individual quirks and of the situation of the investor, it can take up to months. And I checked with Sahil, like, how long did it take to close after you guys did that? He was like, months and months was his reply. And I was like, okay, so there's nothing wrong with us. This is just like how long it takes. But you should be aware of that, because that's again another sort of unexpected time cost. Like when you're a startup and you do something and it takes months longer than you expect, like that's like a non-trivial event, right? It can really have consequences. So just like be aware of that. Those are some of the sort of unexpected things. Oh, and marketing. Yeah, we didn't know what we were doing. We just started marketing. I think we actually did a bit of preparation before the campaign kicked off because we had 3 months due to that audit taking a long time. So we really had time to plan. But yeah, like this was our first time. We didn't know. If we were to do it again, we'd definitely like, you know, be a lot more smoother and tighter because we'd know everything that was coming up.
Okay. Joe Norris has a question that is a pretty good follow-up to that. Unfortunately, she mentioned she can't read it herself. She can't unmute herself at the moment. But how does this all affect the cap table? Is it like an SPV or an RUV where it's a single line item? How do existing institutional investors feel about everyone getting the same terms as they do?
I guess I'll take this one.
Yeah, this isn't really applicable to me.
This is one line on your cap table. There was, while we were doing this, like a friend of mine wrote to me and like insisted that this would increase the number, that this would put us over the 2,500 investor rule. So that there's a rule where, you know, if you're a startup and you have more than 2,500 investors, then you have to make an SEC, then you have to register with the SEC. And so he insisted that this put us over that rule because of something that he was like very, very sure of. And I'm pretty sure that that's not true because I went back to our lawyer who went back to other crowdfunding lawyers who went and talked to other lawyers, and they were very sure. I don't remember exactly what the argument was, but it was basically like something like the condition that makes that true is actually the reverse. And so but the upshot is it takes all the investors and puts them into a vehicle that is just one line on your cap table so that you don't have this like super complex thing. And I think you would call it an SPV. They don't have like the traditional voting and control rights. They have the same economic terms as your other investors. Well, they have the same economic terms if that's the terms that you want to give them. You just set the terms for that. And you know, I would recommend that you set them at the same terms as your last round because it'd be kind of crappy to give them worse terms. Institutional investors seemed perfectly happy about this. We also have very progressive investors, right? And you know, investors like to see other investors pile in after them. So that wasn't really a problem. Overall, because Republic comes from the AngelList lineage, which is very, very founder friendly and founder sensitive to founder concerns, all of those I think are like deliberate product features where, you know, you want to make it simple. It's a simple line on the cap table. It's as easy as possible for you to manage, even though it ends up being very complex. So I presume they took a really, really complex thing and made it only like mildly complex. But it's at every turn, it was really clear that like Republic had a lot of like built-in sort of like product sensitivity to the founder experience, right? They knew what we cared about, and that's like reflected in their product.
Nice, good questions. Thank you both for joining us today. This is a really good good discussion on you know, the case for and against raising crowd equity for your early stage startup company. Yeah, sounds like definitely the sequencing is important. Do it after a traditional fundraise, and also the purpose is important, right? Like for Yishan, it sounds like it was more of a marketing function, more of a way to enroll others and have others participate in the growth of the company than like, hey, we need this money right now to build our prototype. So that's really good key takeaways from this. I mean, you know, there's only a handful of companies that have done these kind of initiatives, and I think only 2 that have done it in carbon removal. If there's any others, it'd be good to talk to them as well. But yeah, really appreciate you sharing this, because the whole point is how do we shrink the timeline for people to get to gigaton scale carbon dioxide removal? It means that, you know, there's cutting edge information or you know, that's coming in, and figuring out how to share it to people that are a couple steps behind you is super valuable. So thank you both.
Thank you, Tito, for excellent moderating as well. And thanks, Paul. Thanks, Yishan. really appreciate your time. CEOs, you're extraordinarily busy, so it's the most important non-renewable resource that we have is your attention today. And thank you to the audience too. Excellent questions. For follow-up, speaking of you as an audience, we'd love to hear what your opinions are about how we can make our events better. To that end, I shared a link to our post-event survey. Our next event is going to be next Tuesday, March 22nd, when we'll have a Q&A on our Launchpad program, which is now open and accepting applications. And the application link is also in the chat as well. So if you are working at a startup that's really early stage and are interested in participating in our AirMiners Launchpad program starting in April, feel free to send us your application. It's free to apply, free to apply. And also the application due date is March 31st, so coming up pretty quickly. With that, we're gonna close now and go to our networking session where we'll be staying in this Zoom meeting and then doing Zoom breakout sessions if we have enough people to warrant that. Until then, until we meet again for our next meeting, wish you peace and hope to see you again soon. Thanks, everyone.